issuing treasury stock. We talked about this briefly past Monday. The treasury stock is the opposite of issuing common stock. A treasury stock, or basically, in a company's perspective, they are buying back the stock. Earlier, they may have done multiple times of issuance of stock, basically collecting capital from the public. Now, what treasury stock is doing, they're basically reversing that action. Sometimes companies think that right now the issue, like the market price for their stock is basically underpriced. They may have a certain price for each share in mind. If they think the price is underpriced, they may buy back the stock in order to support the company's market price right now, the share price outstanding in the market. Other ways, other motivation is that treasury stock may be also purchased back in order to reward their employees. They can buy back the stock and then give it as additional reward bonus at year end to employees based on these bought back stock. So treasury stock journal entries, the first one that we went over is actually just simply buying back the stock. This is the first journal entry. Assuming that there's 1,000 shares that we want to buy back, and at the time point when this journal entry happened, March 31st, the market price of the stock is $5. Okay, so this is what this journal entry means. Whenever a company buy back the stock, is always recorded at the price at the time point when that transaction happens. This is not the par value, not any designated amount that is the stated value of the stock, but at the time point whenever was the market price at that time. Okay, so this is the first journal entry. Whenever we buy back the stock, would debit treasury stock transaction. The treasury stock to the account. So remember that common stock and normal balance is usually the right side. Treasury stock has the opposite balance. Okay, because these are the stock that earlier was issued in the public and now a company buy the stock back. Now after buying back the stock, if they did not, the motivation was not to reward their employees, for example, was to simply support the market price right now, or they're avoiding some of the takeover by other companies, then later on, oftentimes, they may want to resell the stock back to the market. So there are a couple of motivations here. We resell it back to the company, resell it back to the market, and oftentimes, for example, earlier they purchased at $5. Later on, when they sell it back, the market price at that time, let's say 2 months later or 3 months later, was $10 per share, then they gain the profit. Okay, so the difference is like a premium for issuing stock as well. Earlier we talked about issuing common stock. If the face value and market price is different, there's a premium, we call it paid-in capital in excess of par. Right? Now for treasury stock, we can have a similar case. So treasury stock, we also compare when company resells a portion back to the market. Is it the same as the price that they purchased originally? Okay, so this is an example that they sell the treasury stock back to the market, and at that time, perhaps it was not too far away from when they purchased it, the price is the same. Okay, so they purchase it at $5, they resell it also at $5. Say at that time, market price is also $5. But there's no premium to this. We're basically just reversing what we did earlier. Okay, so the first entry is buying back the stock. Second entry is reselling it back to the market, and at the same price, $5. So under this case, basically, they purchase it back, they resell it, there's no premium to this transaction. So there are 3 cases here. It could be coincidentally the same price. It could be at a price at a premium above the original $5. It can also be below $5. Okay, so we have different journal entries, different accounts to use under 3 cases. So another case here, let's say we sell it above the cost, above the original purchase price, $5. And here's an example that we're selling it each share at $6. Earlier we purchased it back at $5, now we resell it at $6. The difference is $1 for each share, the 200 shares that company is selling back to the market. We call it paid-in capital or treasury stock transaction. This account is actually very similar to the paid-in capital treasury stock, we compare earlier the purchase cost with, at the time, the sell price. And if there are differences, we call it a gain capital from the treasury stock transaction. It's basically an increase in equity. So treasury stock purchase transaction is a decrease in equity because you're taking back some of the equity that you issued. Some of the common stock that you issued earlier is taken back. So treasury stock itself, this account, decreases equity. When we sell it back to the market, we're basically reversing what we did earlier. And if there's any price that is above the original cost, we call it paid-in capital in the treasury stock transaction. So after this journal entry, there will be 200 on the right side. And earlier we purchased treasury stock 5,000. We sell a portion back to the market at 500. That's the first transaction. Second transaction, we have 1,000. This part is the part we bought back. This is the part that we resell back to the market. Now the third case here, if we sell it below the cost. In this case, if it's below $5, this is an example that we sell it at, say, $4.30. It could be any price below the cost. And the difference is the 70 cents for each share times the number of shares that we're issuing back to the market, again, 200. Altogether becomes paid-in capital from treasury stock transactions again for the debit side. Okay, so this account by nature is a premium account. Usually it increases equity. But if we do sell back the transaction, sell back some of the shares back to the market at a price lower than our original purchase cost. That difference, $140, will reduce this paid-in capital from treasury stock transaction. For example, here, $4.30. If earlier there was no premium here, we cannot use this account. And we could only debit this account whenever there is a credit balance for us to actually use. Because this account, the normal balance is the right side, credit side. So the example earlier, we did have a premium, and now if we issued at a cost below, issue at a price below the cost, the difference is we can use the premium account, debit 140. In case this 140 happened, before this there was no premium earlier, the 140 goes into retainer account. Meaning that this premium account here, we can only reduce it if there's anything on the right side for us to reduce. That itself is a premium account. If earlier you had no transaction that really had a premium, you can reduce this 140 from that account because there's zero balance there. Okay, so in that case, this sort of like a discount for this issuance will reduce retained earnings. Okay, so here's an example of we're continuing this T account here. We still have, after that third transaction, we still have $60 of balance. Let's say company did another issuance, and again, the price is still below $5. This $4.50 here was altogether having a $100 account. If you think of this as a discount, it's not called discount, but really it's below the $5 cost. Okay, so that $100, if we altogether reduce it from this T account, this would cause a negative balance here. Which is why in this transaction, we only reduce the $60. Once this reaches zero, then $40 will be reduced here. Again, when the company purchases treasury stock, it would be debiting this account. Treasury stock purchase transaction meaning buying back after they buy it back, they oftentimes may want to resell a portion back to the market. And sometimes there is a difference between the price they used to purchase and the price that they are reselling back. It would be a premium here that we report under paid capital treasury stock and cash. So this $200 is the difference between $5 and the new issue price. The difference is times the number of shares. Now we would only debit this account if there is a credit balance there already. So an example here is this transaction. There was a 200 credit premium balance. And now we issue this stock again. This is a price below $5. The difference is we will be able to debit 140 here just because there's 200 there already. If we have a follow-up transaction again, this again is a transaction that we issued out as $4.50. It's below $5. Now the difference is here, the discount that we're getting here is $100. It's actually too much for us to reduce from this account because we only have $60 balance left after that third transaction there. So in case there's $100 that's below the $5 cost, we only reduce 60 here, and then the other 40 goes to retained earnings account. Retained earnings will take over the other shortfalls, the remaining amounts that company resell to the market that's different from the original purchase cost. Okay, so retained earnings account again will take over all the remaining shortfalls that when company will issue stock back to the market. The price differences between $5 and $4. Okay, so if we post all these transactions to T accounts, and treasury stock will look like this. You have left side $5,000, which is the treasury stock that earlier we bought back. And then you see there's multiple transactions of reselling these stock back to the market. Okay, so from April 1st transaction, there's 500 treasury stock being reduced, meaning we sell back $500. And remember, this first entry was at cost, so there's no premium, no discount to that. It's exactly purchased at $5, and we sell it at $5. Second entry here on April 2nd, you see a right side 200 here. That was the original, remember this transaction that we had 200 up there for premium. Difference between $5 and the market price. You know, the April 3rd transaction, you see 140 there. That was the price when we issued. It was below $5. So the 140 sort of like a discount to this premium account. And then April 4th, you see $60 here. Remember, this account at most, it can only be reduced to a point that it reaches 0. Okay, so the additional $40 goes into retained earnings account. Okay, so retained earnings, when we reduce it, we would debit it. So the idea really is the same. This account, we only debit it to a point when it reaches 0. Okay, so in terms of reporting this T accounts into stockholders' equity section of balance sheet, and balance sheet, you see all of this is just the equity section, okay, not including asset or liability. We would start from paid-in capital. Paid-in capital, remember in chapter 12 we talked about preferred stock issuance, common stock issuance. You see I underlined that common stock issuance, originally there was 300,000 shares issued to the market. This is the number of shares that company actually issued. And the line before the 60, the part that I underlined there, the 20 million shares. The 20 million shares is the ceiling, the total number of shares that company is able to issue. But so far, as of now, they only issue 6,300,000. Okay, now, after buying back the stock, remember we bought back some of the stock, we resell it back. Overall, there's still 300 shares that company purchased back. It's still withheld in the company. So this 300 shares times, remember the market price, the cost that they used to purchase. This total 1,500 is a deduction toward equity account. The treasury stock is always listed the very last. We list paid-in capital, externally generated fund, retained earnings is the internally generated fund based on providing service, providing goods. Then the third line, if company do purchase back some of the stock, it's listed a third beneath retained earnings. And treasury stock altogether, the 300 shares represents the shares that companies still withheld in the business. They can decide to reward to their employees. They can also decide next year to sell it back to the market. Again, so if they do sell it back to the market, we will be comparing the cost with that time market price. There's premium, it's reported here, discount reported here. Okay, but altogether right now, they still have 300 shares, and by the price that they used to purchase, $5, altogether this 1,500 is a deduction toward equity account. Because they took back some of the shares that they issued out, take it back so it has opposite direction toward the paid-in capital section. Okay, now the total outstanding stock here, I wanted to point out that outstanding stock is different from issued stock. The issued stock has a record of all together from day one, the starting point of the business, to now, what was the total number of shares that had been issued before, 6,300,000. However, this may be different from what's really there now. Okay, so if treasury stock, if company do purchase 300 back, this 300 would not be affected there because outsiders still need to know what is the record of the total issuance before. The record of total issuance before is 6,300,000, but right now what's really there in the market is after subtracting the 300 shares. This is the part that's really out there in common shareholders' hands. Okay, but upper part, the underlying part, is the number of shares that has ever been issued out to the market. And that is a record that will always be kept there. Then if you see treasury stock, and you know that outstanding stock is different from issued stock. The part that's really outstanding there in the market is after subtracting the treasury stock. Okay, so in case that company did not buy back any number of shares before, then altogether the number of issued shares is 6,300,000 shares, and outstanding shares is also 6,300,000 shares. But if they did buy back the stock, which is reported below retained earnings, then you know that 300 is no longer there in the market. So what's actually outstanding, the number outstanding is different from the number issued. Issued is always a historical record of the total number of shares that has ever been issued out. Okay, but these two numbers may be different if company did buy back some of the stock. Okay, any questions so far? Let's work on a problem on this. Take a look at this. There's two journal entries here. If company purchased 1,400 shares back to their company as treasury stock and paying $5 for each share. It tells you the original par value is $1. Second entry here is after buying it back, they resell 400 a portion of the shares, 400 shares back, at the price of $8 per share. Okay, think about how to journalize these two transactions. And then afterwards, what is the balance of treasury stock T account? first transaction here, we have 1,400 shares that company is buying back, and here it tells you par value is $1, the cost is $5. So we'll be using which dollar amount? We're using the $5 to journalize this entry. Okay, buying back the stock is different from the original issuance. Original issuance, we compare market price with the par value and figure out the differences in excess par. But if it comes to buying back the stock, we're just recording everything based on the original, the cost that we're actually paying out to buy back the stock. So the company will be paying $7,000 to buy back this originally outstanding stock. So you have Treasury stock balance debited $7,000. This $7,000 debit balance, again, is a deduction toward the entire equity section. Okay, now the second entry here, if we resell a portion, 400 shares back to the market at the price $8, and we would compare $8 against $5 originally, the price that we used to purchase. So we have $3 differences times 400 shares, that will give us paid-in capital Treasury stock transactions. Credit side is the premium. So for each share, they originally purchased by $5, they're now reselling back to the market at $8. $3 differences times 400 shares gives you $1,200. Sort of the premium to this account. Okay, so if we post all these transactions, these two transactions into their specific T accounts, and if we look at Treasury stock balance, you would see $7,000 under the debit balance side, and then a deduction $2,000. Okay, because we purchase it back and then we resell a portion to it. So we have just $5,000 outstanding, $5,000 in Treasury stock that company is still withheld in the business, and again, it's a deduction toward the entire equity account. So this, we represent this under balance sheet. You would see a bracket around this number. The upper part, you would see retained earnings, and then the first section, you see paid in capital. This part here is the deduction, so you have a bracket around it. Let's move on to stock splits. Stock splits basically has a similar effect as stock dividends. So we basically, so far we talked about 3 different types of stock transactions other than the original issuance. We also, at the beginning of Monday's class, we talked about stock dividends. Remember, stock dividends could be paid out to reward shareholders as another option that company can use other than cash dividends. Cash dividends is actually giving out check to shareholders. Stock dividends is a way to issue additional shares to the public, and also as a way to reward shareholders. Now, the effect of stock dividends at the time when I talked about it was that there was additional shares issued to the market, and also would likely reduce the market price for the shares at some point. So that depends on whether it's a small stock dividends, over 20 to 25%, or any percentage above 20 to 25% is a large stock dividend. So I mentioned that small stock dividends would be using market price compared against also the face value to see if there's any premium in the issue of the stock. The large stock dividends would just simply use the par value because it may likely significantly reduce market price after issuance. Now, splitting the stocks is very similar effect as stock dividends. Usually when this happens, basically we're not issuing additional stock, but we're just doubling the stocks out there, splitting it. So meaning that if I have one share, say from Walmart's company, one share that worth $100. After splitting the stock, the company issued an announcement that they want to split the stock 2 for 1. That basically means what I have in my hand, 100 shares, not really just increasing the number of shares, but each share, the value is also cut in half. So by doing this, oftentimes this would also trigger a deduction toward the market price for the stock. So if a company thinks that their market right now, the price is overpriced for their stock, let's say each and every share worth 100 in the market right now. I think this is overpriced, and right now the market is stagnant because of this overpriced stock. They may decide to announce this stock split 2-for-1. So at this time, it will basically each and every share's value will be cut in half. This may likely trigger some of the individual shareholders who doesn't have enough fund to purchase a significant dollar amount of shares. And now if each share is just $50, it will be easier for some of the other common shareholders to purchase more shares if each share value is at a lower price. Okay, so this oftentimes will cut the market price to half at the same time and will trigger more trading activities ongoing in the market. So this is kind of the background to why a company wants to do this. And in terms of reporting this on the statements, really there's no journal entry to this, just a memo entry we call. So this is pretty much the only memo entry that you will see in the entire course. Basically just stating what happened. So February 3rd, what happened is the company split this common stock 2-for-1. The old number of shares that was originally issued will be listed in one line, and then the new number of shares, basically double of the original shares, will be listed in the second line. Okay, so that's all to stock splits. In terms of reporting this in financial statements, simply just stating a line of what was the original number of shares, what is the new number of shares. So here's an example of splitting each share into two. So basically the number of shares doubles. You also see par value originally was $1. Now each share par value is 50 cents. So if you use this to time the number of shares, you could be able to figure out that the total equity amount really is the same. Just the number of shares doubles, each share value worth lower. This oftentimes will trigger market price to go down and more trading activities to go on in the market. So this example is 2-for-1. It could also be 3-for-1. So if it's 3-for-1, this part here, the number of shares would be this, whatever was the original dollar amount of number of shares times 3. And then this would be about 33 cents. 1 divided by 3. If it's 3-for-1. If it's 4-for-1, then you will see 25 cents here. The number of shares would be this times 4. Okay, so that depends on what is the splits number that company wants to do. Basically, it doesn't change the account balance number at all. This just changes the number of shares, and each share's par value cuts in half, or cuts in 1/3. So all of these are actually some of the actions that companies can strategically do in order to try and attempt to control market share price. You can issue stock dividends. Also, there will be more shares issued in the market. This oftentimes will have the same effect as this, will trigger the market price to go down. If they think their market price is underpriced, then they want to buy back some of the stock, like Treasury stock. So in that case, the total number of shares out there will be lower, and price would oftentimes boost up a little. Okay, so this effect is the opposite compared to Treasury stock. So if we take a look at the statements, again, only difference is this. If you see the right side, all the dollar amount is the same. Okay, common stock, preferred stock balance, the total stockholders' equity is exactly the same. The blue line here is the effect here, just the number of shares doubled, and each share's value is cut in half. Okay, that's all to this. If we compare all the topics that we talked about so far, cash dividends, stock dividends, and stock split, upper part is the account names. You see common stock account, paid-in capital in excess of par, retained earnings, and then the total equity value. So if you just take a look at the first row, cash dividends. Remember when we give out cash dividends, we first announce it, so there will be dividends payable, and then when it comes to payment date, we reduce the dividends payable and actually pay cash. So for cash dividends itself, really when we announce it, we reduce retained earnings. That's the only account affected in equity section. And of course, cash is affected since we're giving out cash as a reward. Now for stock dividends is rearranging a portion of equity, so we're using our own retained earnings to issue additional stock to give to shareholders. So that journal entry was debit retained earnings and credit common stock. Okay, and then for small stock dividends, if we credit common stock, par value, let's say $1, market price is $5, the difference is $4, we also would increase paid-in capital in excess of par for small stock dividends. Okay, so for small stock dividends, all three categories would be affected, but overall the total equity would stay the same, okay, because we're using our own retained earnings to issue stock. For cash dividends, only retained earnings is decreased, total equity decreased after giving out cash. Now, stock split is the easiest. It absolutely has no effect toward any dollar amount under the equity section. Okay? So common stock number stays the same, paid-in capital, retained earnings number stays the same, total equity stays the same. Okay, because we're just splitting it for the number of shares. Number of shares is different, total amount is the same. Last section in chapter 13, we're going to go into reviewing what income statement looks like again, and then adding a few more sections, and under some of the special circumstances, what income statement would look, how would it look different from the income statement that we talked about in chapter 5. Okay, remember chapter 5 we talked about a multi-step income statement. So for all the income statements, we always start from what? What's the first line of the income statement? Focused on gross profit operating income before. And that's the part in this chapter we added the term here. That's the part we consider as income from continuing operations. And what this means is simply that we just assume that all these operations in the foreseeable future will continue on unless the company announces that they are terminating some of the segments of the business. Okay, we want to mention that this is income from continuing operations because sometimes may have special items. The extraordinary items, for example, if they determine that they want to terminate or sell some part of the business to others, that part of the revenue was separated from continuing operations. company has 5 different lines of business. Even though I have, say, a major part of the business is a restaurant, but perhaps under my companies, I also have hotels, I also have other offices. Altogether, I have, say, 5 segments of continuing operations. But this year, I decide to sell the hotel to others. So that part next year under income statement is no longer there. So the part of the hotel's revenue in this very last year that still belongs to my business will fall under the special items. Okay, that was one example. Later on, we'll go into how it's reported in the statements. For here, you just need to know that continuing operations is assuming the segments of the business is still continuing in the foreseeable future. The company still has a plan to continue them. Sometimes they may decide to discontinue some of them, sell it to other companies. Those part of the revenue in this very last year that still exists in the business will fall under the special items. Okay, other special items also include some of the losses, like under hurricane, tornado, some of the special circumstances, natural catastrophes, earthquakes, the losses that happen, all will also be reported under special items. Okay, as long as that's the area that usually doesn't happen those kind of situations. It's not within the tornado alley, not in Florida. The company basically don't expect to see those circumstances happen again very frequently, and it's reported under special items. Okay, so these are some of the extraordinary cases that may also exist in the business. Earlier in Chapter 5, we simply omitted it, just assume that all segments of the business will continue. Sometimes company would decide to sell a portion of it and would report their revenue in a separate section. Okay, so let's take a look at the income statement that you're familiar with. Is the one with the blue bracket around. Start with sales, and then we have cost of goods sold reported. This gross profit is the first total. And this we talked about in Chapter 5, and then there's many different operating expenses. After that, we get the second subtotal, operating income, which in this example would be $79,000. Okay. Now, other gains and losses. Remember, gain on sale of machinery. This is the topic we talked about in Chapter 9. Trading long-term assets. Compare what we receive with what we're giving away. So gain and losses, $11,000 here. After considering all of them, now we consider this $90,000, we call it income from continuing operations before tax. Okay, so the blue part here is some new things that you need to know, starting from the green arrow over there, income from continuing operations before tax. So all the incomes generated in public traded companies will be taxed a certain portion. In this chapter, we assume the tax rate will be given to you in the problem. In this chapter, we assume this state is 40%. Okay, so the $90,000 of income that company generated, 40% will be paid to state and state government, the IRS, and what's remaining is $54,000 that they're really keeping. Okay, so this first section here is called continuing operations section under income statement. Continuing operations section, and if company do have special items, then they have special items section. And then the last part is earnings per share section. Okay, so income tax here, again, the tax rate will be given to you. What you need to do is, when the problem tells you what is the net income amount for continuing operations, just times the tax rate and find out what's really remaining in the business, $54,000 after tax. For most of the businesses, they don't have those significant, for example, a natural catastrophe that happened, they don't have any terminated business segment, then pretty much this $54,000 would just be net income. Okay, if they don't have any special items. This year they did not decide to sell any segments of the business. They did not encounter any earthquake losses, hurricane losses, or anything in that area. And basically, this will be pretty much the end of the income calculation part. 54,000 will be exactly the net income. Okay, but in some cases, if they do have special items, then we also need to report this below continuing operations. Okay, this part is just showing you the calculation. 90,000 minus 36 will give you 54 after tax. So the special items breaks down to, again, two parts. The parts that we sell out to others, discontinued operations, either just simply terminated it or sell it out, and the part that's considered extraordinary items. Okay. So here's an example that we continue for $54,000, and let's say that we discontinue this segment of the business. Going back to that example, let's say we want to sell the hotel part of our business, and this year they still generated $35,000 of revenue. This is the part, the last year that it exists in our business. Whatever they generated here was reported separately, separate from continuing operations. Okay, now the less net income tax part, again, this revenue will be taxed, so this is the part that will disappear. What we're really keeping is just $21,000. Then for extraordinary flood loss, let's say that this actually happened in the business. We lost $20,000. This again also has a net tax effect, so we're really reducing is just $12,000. So overall the net income after these two items is $63,000 altogether. This is different from 54 because we haven't considered these two parts of the income. Of income, regardless of continued, discontinued, we all consider the tax effect to it. So the 40% would always be paid to the state government, basically IRS. That's the part that company is not keeping. Okay. Any losses, $20,000, we also consider net tax effects. You can also think of this entire calculation as 90,000 minus plus the 35,000 that we gain from discontinued operations minus 20,000 times 40 is the total tax that we pay. And we separate them into three sections and consider their net tax effects, but really overall it looks like this. Okay, and then what the company is keeping would be 1 minus what's there. Basically what they're keeping is 60% of their earnings. Right, because tax is 40, so they're really keeping 60% of it. Now I start from 90 because earlier this example tells us that up to that point before tax is 90. Consider all before tax first, and then times the tax rate. That would be the same as considering tax effects separately. So once again, this is the most complicated case. Sometimes companies do not encounter these situations, then the net income would just be $54,000. Okay, but if they do have these situations, we're a part of them, and we consider them first, and then we calculate the up-to-date net income. Now the reason why we're separating this discontinued part is because very likely next season's net income would be significantly dropping, for example, like around $20,000. Okay, because next season, if the company, this is the last season that they still have the hotel, assuming this is the hotel business that they own. Next season, they do not have this anymore. They decide to sell it to others. Then naturally, the net income, the income statement that you see next year will not be as high as this year. Okay, so this is giving creditors, investors, additional information that was signed for them, knowing that next year or the following years, very likely net income will not be $63,000 this much. Probably around $40,000 because they don't have this segment of business anymore. Okay, so this is really not because of net loss or any additional operation flaws, just because they have a major segment of business that's no longer there. That's That's why we want to separate it. Whenever you see this, that basically means this is the last year of this section of the business in this corporation. That's why we separate it. Last part to income statement would be earnings per share. This really is just using whatever you see here as net income. We divide it by the number of shares outstanding. That's all it is to this EPS measure. This measure is often used by creditors and investors too to evaluate, compare different businesses' earnings that can be attributed, can be designated to each share. So if I own a share that has earnings value EPS, let's say $3 or $4, compared to other companies' earnings per share is only $1 or $2, my shares that I own right now is more attracted to their shares. Okay, so this is the number of shares that can be assigned to the number of earnings, the amount of earnings that can be assigned to the number of shares. So for each share that shareholders own, what is their earnings value to? That's what this measure is. If you look at the formula, is actually very similar to ROE. Remember, rate of return on equity. The only difference is that the denominator part at that time is the total, the average equity amount. Here it's the average number of shares. So it's just another perspective to look at it. You can look at it as rate of return on every dollar of equity common shareholders contributed to the company. This is looking at the number of earnings that can be assigned to each share. So if you and I own different companies' shares, we can compare our EPS and understand which of our shares has slightly higher value than the others. If you can assign more earnings to the number of shares that you own, that basically means the value of the share usually is higher than other companies. Okay, so this part here is just a calculation of how we get to net income. So really what is considered EPS is this, $3.50. So upper part net income, $63,000. If there's no preferred shareholders, then that will be it. We divide it by 20,000 outstanding shares. You know, the formula tells you the average number, but usually for other problems you see pretty much would just be one number. It will tell you the total outstanding shares is 20,000. You just use this directly. You don't necessarily need to add beginning and the end. It doesn't tell you what is the beginning shares and ending shares. Most of the problems you see in this problem, even though it tells you average, but usually it's just the total outstanding shares as of now. Okay, so it's 40,000 shares, and you just divide it by 40,000. So this is a case without preferred dividends. We're just considering total net income. If this company didn't issue preferred shares, then we don't subtract anything. Just use 63,000. Okay, now in case there is preferred shares issued to the public, then we subtract any preferred dividend that we gave out to preferred shareholders, subtract that out first, excluded, and the remaining 53,000 divided by, again, common shares, 20,000. Remember the idea that preferred shareholders' right is always considered first, and then common shareholders receives whatever is remaining for dividends. Here, since we're considering EPS is only for common shareholders' earnings per share. So any preferred dividends that was gave out from retained earnings was subtracted from net income. Okay, again, so EPS for this case will be $2.65. Just going back to that formula, the net income minus preferred dividends divided by shares. For part 1, 2, 3, 4, it's just breaking down the income into what part is continuing, what part is discontinued. The really important part here is just the last line. Let's work on a problem on calculation for EPS. So first question is asking you what is the number of outstanding common stock. Second, if we can calculate EPS. First of all, what is the number of outstanding stock here? 50,000 is the preferred part. Sorry, what is the outstanding of the common part? Common stock part. The EPS is all about common. So we have the number of shares is asking not the total value of it, just the number, how many shares I have to, or just the unit of it. So we have 53,000 issued. But remember, we have Treasury stock here too. Treasury stock is a deduction toward what's actually issued out. So the issued stock will be 53,000 issued minus the 1,200 shares. The total outstanding stock, again, may be different from issued stock. Issued stock holds a record of historically what is the total number of issuance. But we buy back the stock, and that will deduct what is the outstanding shares. This is the first question. The number of shares outstanding is only 51,800. 1,200 is withheld by the company, and the 51,800 is out there in the market. Okay, now the reason why we're doing this first is because EPS needs to use the number of shares here as the denominator. So if we want to calculate this, net income, it tells you is $118,000. You know the number of shares, common shares outstanding is 51,800. How do we get this? How do we get preferred dividends? Preferred dividends is calculated based on, where do we start? We start from 1,000 shares, that's totally outstanding, and the value of each share is $50, and the rate of dividends rate up there is 3%. So what would be this dollar amount? 1,500. So this will be the total part of cash dividends that preferred shareholders is getting. Remember, this is where EPS is talking about common shares value. Subtract this preferred dividends first. So this 1,500 will be subtracted from 118,000 and then divided by the outstanding shares. This will give us the value of each share, what is the earning that is attributed to each share. Okay, net income minus preferred dividends, because EPS is about common shareholders' value. So we subtract preferred dividends divided by outstanding shares, the number of shares. Okay, so each and every share, if we round it up, each share's earnings value is $2.25. Okay, preferred dividends again. This is important to calculate. Preferred dividends, common dividends. Preferred dividends always gives you a rate, percentage rate of dividends. You use that rate. That is the rate for each value, each share's value, which is $50. Okay, so this times the rate times the total number of shares is the total check value that preferred shareholders is receiving, 1,500. So if another company's EPS is $1, compared to this company $2.25, this is stronger. Okay, for ROA, ROE, EPS values, the higher the better. All of these, the numerator is about earnings. So the higher the earning is, basically there's more value to each share. So if the same company next year, let's say that they still earn the same number of net income, they still give out the same number of preferred shares, but let's say they issued more shares out, they collected the capital from business, from shareholders. Let's say they issue 10,000 more shares, But based on issuing this 10,000 more shares, supposedly they have more cash next year. They externally generate the funds from shareholders. The next year, their net income is still the same as last year, and the EPS will basically go down. Okay, because the higher the number of shares is, and the net income remains the same, then basically each and every share's value goes down. So meaning that they're not doing a better job next year, even though they got more funds from shareholders, their net income still remains the same. That basically means signals that they're not really using the fund very well. So we can compare EPS across the same company different years and also across industry. If it gradually goes down, that means the company is not really doing a good job using the capital. So another opposite example would be having the same number of shares. They didn't issue additional shares next year. The next year they're doing a better job in terms of perhaps using internally generated funds. Like they're selling more items out, they're providing better services to customer. This goes up and earning per share will go up, and that's a good sign. Okay, that's all to chapter 13. Any questions? We're going to start a little bit of chapter 14. I'm just going to know the basics of this. This I'm going to skip over. 14th statement of cash flows is just about cash inflow and outflow. Okay, this last statement here really uses all the prior three statements information. We're not creating new information. What we're trying to do in this entire statement is understand cash balance. Remember, cash appears under the balance sheet, right? Cash account is the first thing you see on a balance sheet. Asset section, first account is always cash. And we want to compare, let's say this year's cash balance, if it's $10,000, assuming last year is, say, $5,000. So $10,000 compared to $5,000, this year we had a whole lot more cash, additional $5,000 balance compared to last year, and we want to know why. Okay, so this statement is all about why is there additional cash compared to last year, and in detail, where does it come from? Does it come from selling more items to customer? Does it come from borrowing money from a creditor? Does it come from issuing stock to the market? So this entire statement is a detailed list of where cash has been going in and out from the business or to the business. Okay, so the purpose here is to understand cash balance, why is it different from last year, and in detail which specific category that we use a lot more cash than others, which specific category we received a lot more cash from others. Okay, so we will separate these into operating activities, investing, financing activities. So pretty much summed up what this purpose of statement of cash flow is about. Comparative balance sheet basically just means 2 years of balance sheet. If we compare together, putting it next to each other, that's what we call comparative balance sheet. Just 2 years of balance sheet listed together side by side. We want to know why is there a difference balance in cash. So where did the additional cash come from? Or where did we lose a lot of cash in this year? So the entire statement is summarizing cash payments and receipts. Now for this entire cash flow statement, in the first section, operating section, we will move backwards from net income and try to reach the cash balance and cash from operating activities. Okay. Later on we'll talk about why we're actually looking from net income, but basically it goes back to the accrual accounting concept. Okay, so net income you see in income statement, earlier we were talking about $63,000 net income. That net income may not necessarily be cash increase, $63,000. Remember that companies can sometimes make sales on account. So what does that on account mean? Sales on account refers to money that you're receiving account. Sometimes, not sometimes, the idea is that on account basically doesn't represent cash yet. So making sales on account is $500, we haven't actually received cash, we don't report it under statement of cash flows. So we're purchasing assets on account, creating accounts payable, purchasing inventory, we haven't actually paid the cash, we don't report that under statement of cash flows. Okay, so net income dollar amount sometimes includes some of the revenues that really isn't cash yet, but also reports some of the expenses that we actually haven't paid out. We want to pull them out because statement of cash flow is just purely about cash inflow and outflow, not about the stuff that we reported as on account. Either payments that we haven't made or cash collection that we haven't got from customer. Those parts we will exclude. Okay, so that's why here you see the communication link between accrual basis income and cash reported on balance sheet. So accrual basis, we will ask you to account is basically record all the revenue whenever it's earned, but sometimes it's not yet cash. We would also record all the expenses, even though we haven't paid it out. Record it as, remember, like accounts payable, salary payable, those are the things that recur future cash payment. So we want to tease them out. So report all the things that only belongs to cash inflow outflow under statement of cash flows. Okay, so this part here, I'm just going to show you a comparative balance sheet. Looks like this, just side to side, 2 years of information, and we want to know why is there a decrease in cash balance $20,000 in detail. So under statement of cash flow, you would see overall cash difference $20,000 and a whole list of why is there the $20,000 differences. Where does it come from? Okay, so basically the purpose here, we want to use statement of cash flow information. This will help definitely investors, creditors to predict next year's cash flows. So oftentimes the company didn't do a major investment this year, while some of the segments of the business, oftentimes cash flow, the range will be similar to what happened this year. Okay, so they can also evaluate management decisions, understand whether they have used too much cash in certain areas or too less in certain areas. Okay, they predict the ability to pay debts and dividends. If I'm the creditor and I borrow money to this company, definitely I would have all the interest in understanding whether the company will be able to pay me back money. Okay, so by looking at cash flow statement, you can understand whether the company has enough cash balance or not. If I'm the shareholder, I'm also interested in whether the company is able to pay me dividends. So this is also some of the things that we want to understand from statement of cash flows. Right, now the three sections that we'll be going over in statement of cash flows breaks down to, first one is operating activities. Here we just have to know a basic understanding of what operating activities is about. Anything that you see under income statement that affects cash would be reported under operating activities section of cash flow. Anything that you see as revenue, you see as expenses that affects cash would be reported in the first section. Also, anything that relates to current asset or current liability. So if we purchase inventory, using up our cash, the part of cash that we use up reports here. Okay, if we, for example, borrow money, but it's a short-term money, current liability, also reported under operating activities. Okay, so payment of liability reported under operating activities. Any revenues, expenses that we paid off or we received actually by cash, we also reported under this.